Welcome to the lecture on working capital management. This is intended for students in Financial Management 342 or FIM 342. The working capital is essential for all business activities. Companies need working capital to operate efficiently. And then changes in working capital will influence the cash of the company and the cash balances available. Ideally, working capital, which are current assets, should be financed by current liabilities, like trade payables and overdraft. This diagram aims to show how the working capital cycle works and where the cash investment comes from. Try to picture a manufacturing company. So first, before they can manufacture anything, they have to buy materials. So if they buy materials on credit, so they owe the suppliers, they don't pay anything. Now they keep this raw material inventory until they start the manufacturing process. This could be a few days later. Now it takes a few days to manufacture the products. Remember, they don't have anything to sell yet, and they still owe the creditors. Once the goods are finished, the manufacturing process finished, they store it in the inventory store. This could stay on the shelves for a few days before it's sold. Now, if the competitors sell on credit, the company will probably also have to sell on credit. Otherwise, the customers will go elsewhere. So now they sell the goods, so they don't have it anymore. So they still don't receive any cash yet because they sold it on credit. So now a few days later, it could be up to 30 days, they collect the cash and only then do they have cash available to pay the creditors. But remember, the creditors could have demanded the cash a lot earlier, so that's where the shortfall comes in. Okay, here you can see the same thing. We just put some days into it. So raw material inventory on average lasts 45 days. We'll look at the calculation later on. Then after 45 days, it's put into production. And that lasts 35 days. So now, it's 80 days before we have the finished goods available for sale. Now on average, they might keep the inventory for another 50 days. So that's a full 130 days before they make a sale. Now the creditors may only give you 3 months or 90 days credit. It could be anything. So after 90 days, the creditors will start phoning up and say they want the cash, but we only sell after 130 days. And then we might give another 60 days credit. So cash is only received after the full, that's 45 plus 35 is 80 days, plus 50 is 130 days, another 60 days, so 190 days. But creditors need to be paid after 90 days. So we've got a shortfall of 100 days, for which we require short-term finance. Now, certain levels of working capital are required to run efficiently, like the inventory and debtors and so on. So what are the risks for the company if they don't have any inventory? Well, they could run out of stock. Customers want a certain product and now they don't have it, so they go to competitors. Or if it's in the manufacturing environment, they need a specific raw material, it's not available, so production has to stop. And they run into bottlenecks. What about debtors? If they don't sell on credit, competitors could be selling on credit, so they lose out on customers. Also, if you give more lenient credit terms to your customers, it might persuade them to buy from you instead of from the competitors. What if you are low in cash? Well, if you don't have cash and some unforeseen circumstances happen, you need cash immediately to pay for something that broke or a supplier that only ships on cash, then you can't do it if you don't have cash available. Now you might ask, well, if inventory, debtors, and cash are so important for the company to run efficiently, why don't you just keep lots of it, lots of inventory, and give lots of credit? Well, the problem is you have to invest in that. You need cash in order to hold lots of inventory and to supply on credit. And that cash is tied up in this working capital and you can't use it for something else. So there's opportunity cost. It's that return foregone on that cash that's tied up in working capital. So the objective is to keep a balance between keeping enough safety stock and giving enough credit, but also not tying up too much cash so that you forego the return or the opportunity cost on that cash. So the objective should be to basically shorten the working capital cycle as much as possible without affecting the efficient running of the company. You have probably seen these calculations before, but I'll just quickly run through them. So how do we calculate the inventory days, debtors days, and creditors days? So for raw material inventory, you basically take the raw material balance on the balance sheet divided by the purchases amount multiplied by 365 to give you days. Same for working capital. You take the work in progress. Work in progress balance on the balance sheet divided by cost of sales times 365 for days. And then finished goods inventory, you take the finished goods inventory balance on the balance sheet divided by cost of sales times 365. So you can see it's the same. It's every time you take the balance sheet balance and you divide it by the line item in the income statement. And then you multiply it by 365 to give you days. Debtors days, or the collection period, is basically the trade receivable balance on the balance sheet divided by credit sales, or if you don't have credit sales available, you use total sales times 365. And then lastly, the creditors days, or the settlement period, is your trade creditors outstanding on the balance sheet divided by credit purchases if it's available, otherwise just total purchases, then times 365. The reason we use credit sales and credit purchases only is because you want to calculate on the credit sales how long does it take to receive the cash, and on credit purchases how long to pay. But if you mix it with total sales, so you include cash sales, if that's the only available figure, obviously the days are going to be shortened, and that's as a result of the cash sales which are received immediately. And the same counts for purchases. Now, the problem with working capital is seasonal fluctuations, because that causes fluctuations in the levels of working capital, and then as a result of it, you need short-term financing to cover these fluctuations. So working capital requirements can be divided into the permanent current assets, so that's your permanent level of inventory and trade receivables and trade payables, so the long-term average, and then the fluctuating part of it as a result of seasonal fluctuations. So here you can see it graphically. We've got the non-current assets that are fixed assets at the bottom. Then we add our permanent current assets. So if we have a policy of keeping a month's worth of inventory and we give 30 days credit to our customers, that'll be the permanent current assets. And then as it fluctuates because of seasonal demand, we have the two hills and valleys here at the top, the fluctuating current assets. Now the problem is, how do we finance these? So we basically have two decisions here. That's very important. What level of working capital are we going to keep? And how do we finance it? And we've got three different approaches. Well, it's basically on a scale, but the one end would be a very conservative policy. So we keep lots of working capital and we finance it with long-term loans, and then we have very aggressive policy where we have very low levels of working capital and we finance it with short-term liabilities. And then moderate policy is somewhere in between. So here you can see the relationship between risk and return. The higher the risk, the higher the possible return, and the other way around. So let's look at this company. We've got sales of 80 million. We've got operating income or profit of 9 million. Then in the conservative policy, you'll see we have lots of current assets, so lots of safety stock, lots of credit to supply to customers. And then very low levels of current liabilities because we finance it with long-term liabilities. So our net working capital is 35 million. Add that to our non-current assets, we have 75 million of assets. So our return on assets would be the 9 million profit divided by the 75 million net assets. So that's a 12% return on assets. And our current ratio is very high because current assets divided by current liabilities is 2.3. So it's very safe, but our return is quite low. Then the aggressive policy, we have less current assets, so 20 million less, it's 35 million current assets, 30 million current liabilities, so we finance it more with short-term liabilities. So our net working capital is very low, only 5 million. So then our net assets is 45 if you add the non-current assets. So our return on assets is almost double at 20%. That's the 9 million profit divided by the 45 million net assets. And our current ratio, you can see, is almost 1. It's 1.2. So very aggressive, very risky, almost just covering our liabilities with our current assets, but our return is much higher. And then the moderate policy is somewhere in between. So we balance off the possible expected return in the future with the risk involved. So what drives working capital? Increase in forecasted sales will spontaneously increase the levels of current assets and current liabilities. Because as we increase sales, we will increase our cash received if it's cash sales, or we'll increase our debtors if we sell on credit. That'll happen automatically. Then as we increase sales, we have to increase our purchases and our production, which will automatically increase the levels of inventory and the levels of suppliers or creditors outstanding. So again, a conservative policy is a lower expected return, but there's lower risk involved. Aggressive strategy is higher expected return with a higher risk involved. But remember, we're dealing with expected return. It's uncertain, because if it was certain, then the higher returns, if that was certain, there won't be any risk, and we'll always go for the aggressive policy. So obviously, it's higher possible expected return, but higher risk. So the optimal policy is somewhere in between. So how do we finance working capital? The one strategy is to match the maturity of the assets to the finance. So short-term assets with short-term finance, and then long-term assets with long-term finance. But it's very difficult due to the uncertainty involved. So again, there's the 3 strategies. So you can see the moderate financing strategy, where our non-current assets, the fixed assets, plus the permanent portion of current assets are financed with long-term loans, and then just the short-term portion with current liabilities, the fluctuating part. Aggressive policy is where we take long-term financing for the non-current assets, the fixed assets, and only a portion of the permanent assets. So we've got short-term financing for a big portion of our permanent current assets as well. So lots of suppliers or trade creditors outstanding, but less inventory and working debtors. Then a conservative policy is where we finance all of our non-current assets, the permanent portion of current assets, and a portion of the fluctuating current assets with long-term financing. So it's much, much safer, but there's less future expected returns. So in the next presentation, we'll look at working capital management, so how we manage our inventory and our debtors and our suppliers, and then how do we finance the current assets. So just click on the link to go to part 2.